The market data they don't want you to see. Now, if I intentionally showed you misleading financial data, do you think I could change the actions that you take with your money and investing? Of course I could, because it's the data that helps us make decisions, that shows us what to do. And that's exactly what's been happening. You've been given both false and misleading economic data in order to manipulate what you do with your money, and for others, just to drive up views. But don't worry, I got you, because I'm always going to tell you what I would want to hear if I was on the other side of the table. So in this video, we're going to break down some of the data that you've been lied to about, what the false and what the real data is. Forget the headlines. We're going to look at the changes in this data, what they mean to you, and of course, most importantly, what you should be doing about it. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss. I make these videos to change the way you think about money, because almost everything we've learned is wrong. Almost everything we hear is wrong. And we're going to talk about the data, how the data that you're seeing from others on YouTube and Twitter and legacy media, the data is wrong. What the government is giving us is wrong. It's manipulated because they're trying to manipulate you. So we're going to look at some of the manipulated data, and we're going to compare it, like I said, to the real data so you can see the difference. I'm going to tell you what all this means to us as investors and business owners, and what we should be doing with this new real data that almost everyone is missing, all right? But first, why do you think they want to show you false data to begin with? Well, the simple answer is because they want to manipulate your actions. So then, who are they? And what actions are they trying to manipulate you into? Well, let me answer this first, and then we're going to break down the three main points that I want to cover. So the two main groups that they want to show you, either false or misleading data. First, it's the media, right? It's mainstream, it's legacy media, the talking heads on social media and YouTube, and they're doing it mostly for shock value, right? They want to get fear, they want doom and gloom, and they do that in order to get more views. Unfortunately, a lot of people are more attracted to that, all right? Now, some of the legacy media outlets are also doing it in conjunction with the Federal Reserve and the government, sort of as a mouthpiece, like the Wall Street Journal, the Washington Post, all right? Now, there's two reasons why the Federal Reserve and the government want to show you the false data. First, they're trying to crush demand, right? The Fed is trying to slow down inflation by crushing demand, and so they want to scare you so you don't go out and spend so much money. Second, they don't want you leaving the dollar or fiat and buying assets. If you're not scared into staying into cash, you're going to go buy gold, you're going to go buy Bitcoin, you're going to go buy houses, and they don't want that to happen. Now, the reason why they don't want that to happen is they want you holding cash while they are rushing into hard assets. All right, we've talked about this before. They want you stuck in cash while they buy up all the real things. Okay, so now, let's break down some of the biggest lies and some of the biggest misleading data that you're being fed right now regarding the economy and the markets that are causing you to make bad decisions, that are causing most people to sit on the sidelines. We just saw November, the best performing month of the year, one of the best performing months we've seen in years and even decades. And I've been telling you for a year, don't worry, don't buy into that Fed doom and gloom, but here we are. So first, let's look at a couple things that you're being fed. So first, we're being told that consumers are broke, right? The economy is horrible, or certainly recession or depression. People are only able to survive off of credit. Now, while that's certainly true for some people, and this is also true for more people today than it was maybe a year or two ago, if we look at the data, the actual data, we'll see something different. Now, you might see people on social media and YouTube showing you a chart like the one I have up on the screen right now, showing you the longest continuous drop in bank deposits in US history. All that money's leaving, look how bad it is. But if you zoom out, you can see that bank deposits actually went parabolic in 2020, and they're still near all-time highs right now. And now another thing that we were told is that the banks are crashing. Get your money out of the banks. We were told that after the banking crash in March of 2023, that the small banks were going to get crushed as everyone moved their money to the large financial banks. And then when that happens, then there was no loans going to be created. but that never happened. As you can see to the chart on the screen, small banks actually still have all their money. And yes, while larger banks did see a small hit, small percentage of depositors did pull their money out of the banks, but only because they took that money that was paying no interest and moved into high-yielding money market accounts, as you can see from the chart on the screen, which is at crazy parabolic all new heights. Now, this is leading to what I'm calling a cash asset bubble. This is also the topic of a live event that I'm going to be having later in the week. There's a link to it down below where I'm going to show you what I think this cash asset bubble is, what I think is going to happen to it, and why you need to be paying attention, because as this bubble deflates, it's going to cause all types of movements in the market, and I want to be there in front of it. Hopefully you do as well. So join me. There's a link down below if you want to come check out this free live event. Ask me any questions. I got about like 30 charts to show you. Anyway, let's just keep going. Financial headlines tell us that the consumer's weak. We see this because spending is dropping, but of course, the data shows the opposite. In fact, retail spending is still booming. In fact, we see that we're at all-time highs, as you can see from the chart on the screen. This is going all the way back to 1950. But Mark, consumers are using credit cards. Don't you know that? Haven't you seen the amount of credit consumers are using? Credit consumption is going up while bank deposits are going down. Well, we already covered the bank deposits. So what about the credit consumers? Well, yes, that's true. The credit that consumers are using is going up. Now, we're being told that the surge in credit card borrowing shows that we're going to have a crash. But the thing is, compared to what? Relative to what? If we look at consumer credit relative to price levels and nominal incomes, then we can actually see that consumer credit is actually lower today than at the start of COVID in 2020. But we're being told that there's a 300% rise in hardship loans. That's also true. But if we look at this in perspective, we can see on a macro scale, zoomed out, it's a tiny little blip. Now, we are also being told that there's like, oh my God, 1.1 trillion in credit card debt, which is also true. But the percentage of credit card debt relative to the amount of money in the bank is near the lowest it's been in 20 years. But if we jump into the details, we can see that credit card delinquency as a percentage of total credit card debt outstanding is about $27 billion or 0.1%. And then again, we need perspective. On all this, we need perspective. If we zoom out, we can see that credit card delinquencies actually during the boom times, let's say of like the 90s, were almost double this. They were at 0.19, almost 100% more than they are today. But how will consumers afford their debt with the sky-high interest rates that the Fed did by raising them so fast? Well, we can see if we look at the data that the household debt service payments as a percentage of disposable personal incomes are actually historically low. Now, the more we look with perspectives, we can start to see that many of these things are just a reversion to the mean. We have to remember, in 2020, we saw the greatest amount of monetary and fiscal stimulus we've ever seen. About $10 trillion was dumped into the market, which pushed everything to parabolic heights. So a lot of what's happening is we're coming back, a reversion to the mean. If we have a mean line, we went way too high, and now we're coming back down. What about housing? Housing's crashing for sure, right? I mean, the Fed raised rates at the highest rates in history. We went from 2% to 3% mortgage, now 8%. It's got to crash. Well, they've been saying it has to crash for 2 years now. It has to crash, but it hasn't. But it's going to, right? Well, everything's going to crash. I can guarantee 100% that yes, we will have a crash. But when is the question? Will it be in 1 month, 2 months, or 10 years? It's going to happen, but it may not be happening. Well, at least it hasn't happened yet. Like for 2 years they've been saying, and we can see headlines all over the place, right? We can see right now, hedge funds are buying 44% of all single family homes that we were just told this week. That was making the biggest news headlines over the last week, but this isn't true at all. As a matter of fact, it's not even close. It's not even close. It's so far off that it's not even an error. As a matter of fact, it's a straight up lie. The data shows that in quarter two of 2023, institutional home buyers accounted for only 0.4% of home purchases, not 44%, 0.4% of home purchases. And actually, we've seen an institutional homebuyer slowdown over the last 18 months. So not even 1% in Q2. Now, institutional operators, which would basically be those that own at least 1,000 homes, own 0.73% of the single family housing stock in the United States, one in about 137 homes. Now we see 3.4% of US single family homes are owned by operators with 10 or more units. So you have to look at the data. Now this news about this 44% of homes being bought by institutional investors came from some obscure post on Medium. Now, the post cites links referencing back to the BI and links to an Atlantic article. Now, the Atlantic, another mouthpiece for the government, so be careful where you get your data from. Neither one of those articles support this 44% claim. Now, for reference, at the height of the pandemic housing boom, they were about 1 in every 42 home purchases. But today, institutional buyers, which again own more than 1,000 homes, make up just 1 in 250. So pre-pandemic, 1 in 42. Today, 1 in 250. But Mark, you don't understand. Home prices are crashing. Okay, I see it on Twitter. I see it on YouTube all the time. Videos talking about this imminent housing crash, getting lots of views. The problem is they're not crashing. Home builder stocks are up 27%. The supply of homes for sale is still near historical lows. And again, for perspective, if we zoom out, in 2007, right before the great financial crash of 2008, the home builders had to deal with massive amounts of inventory. There was 4 million active listings. So that was massive oversupply when there wasn't a bunch of demand. 4 million active listings. Today, 2023, the same data line is at 1.1 million. About 75% less supply than there was demand in 2007. But what about the massive sales crash? Didn't you know prices are crashing everywhere? Well, they did. They did crash in 2022. And per the Case-Shiller Index, they've already come back up. They crashed in early, like I said, last year, like 2008, except for that we're missing roughly 3 times the inventory that never came, like the 2008 crash. And for those waiting for this spike in inventory, they don't consider that we didn't have this massive credit boom like we did in 2008. Now, could we have a massive spike in inventory? And if we got this massive spike in inventory, could that lower home prices if there was no demand? We could. It's a lot of assumptions. If those things happened, but so far they haven't. And this is the big thing. Hopefully you're starting to catch on. There's lots of things that could, maybe will, maybe should happen, but they're not. Now, the media and the headlines, they're trying to get your click. They want your view. They want you engaged. All right. And some of it's coming from the government themselves. As a matter of fact, the BLS, the Bureau of Labor Statistics, is the main purveyor of misinformation, pretty much like all government information. Now, this year, the BLS revised almost every single release after it came out. They put out the report with knowingly wrong, misleading, misinformation data, and then they revised it later, hoping that nobody would catch on to it. The reality is that much of the economic data in the US is BS. BS from the BLS. Any data point that has any political significance, GDP growth, inflation, unemployment, etc., it's all wrong. It's all massaged, it's manipulated, it's misinformation. It's manipulated to the point that has basically no correlation to reality. Consider the official inflation measure, the Consumer Price Index, the CPI, for example. Last month in October 2023, the BLS claimed that health insurance costs dropped 34% year over year. Now, my health insurance, they didn't drop. My health insurance costs are up dramatically from just 12 months ago. I've yet to see any data or heard from anybody that suggests that health insurance costs fell for anyone, much less 34% year over year. All right, so now that you understand the real data, that we've gone through, and you understand how the real data is way different from the fake data that we've been reported, what does this mean to us? What do we do with it? Well, the first thing is we have to understand that we need to be zooming out. Again, remember, what a lot of this newsworthy clickbait headlines are is because we're reverting back to the mean. This sugar rush is running out. So we need to zoom out. We need to be able to gain perspective. So I do like charts because I want to see the direction, I want to see the size and the speed of the move. It's important. But we also have to zoom out far enough to know where the trend lines are. Where was the data before these anomalies? When you go into a period like in 2020 where they pumped in $10 trillion of monetary and fiscal stimulus, it sort of disrupts all the models that we have, which is why when you hear people giving you honest data, they'll typically go back to pre-pandemic and start to use those numbers, all right? So that's important. Now, I get it, you know, the fiscal spending is now up 50% since the pandemic, and so that starts to change things, and it has. So you have to understand all these things. You have to have critical thinking. You have to understand, who am I receiving this piece of information from? Who are they? What are their motives? And what is fact? And what is opinion? That's why I try to bring you the numbers, what I call the receipts. I want to show you the charts, the dates, the graphs. I want to give you the facts. And yes, I'll try to connect some dots for you, but I want to give you the facts and you can connect those dots for you. All right, so now you know the real versus the fake data. Now you know why this matters. Now, what do you do with this? All right, now that you know this, what do you do with it? Well, the first thing you need to do is you need to learn how to get the data. All right, you need to learn how to look past the news headlines and past the opinion to get the actual data. So you need to skip the headlines. Now, the other thing that you need to do is you need to be looking at different types of data, all right, for the facts. So let me give you 3 things that can really, really help you develop as a trader, as an investor, okay? The first thing you need to do is you need to push yourself to have a non-consensus view. All over YouTube, Twitter, etc., the consensus view is the whole world's gonna crash, the market's gonna crash, etc., right? So what's the non-consensus view, or what's the opposite of what you're thinking? Basically, instead of looking for information that confirms your bias, you need to go seek out information that challenges your bias, all right? I learned this a long time ago. I had this Fortune 100 consultant working in my business, and people that worked for me would say, I could never do that. I could never get 10 sales by Friday. What are you talking about? And he'd say, never? There's nothing you could do? No, there's no way that could happen. So if I walked in 100 clients ready to buy right now, you couldn't sell 10 of them? Oh, well, if you did that. Okay, so then you're saying there's a chance, right? And so we need to look at the extreme edges to start to understand things differently if you want to have a non-consensus view. The second thing is you have to test your logic to see if it's any good. And was it any good in the past? Right? So we have to go back in time. So not just in this current period of time. This is a main emotional thing that most of us as humans, these mental models we fail with, which is called recency bias. We tend to think that whatever's been happening recently will continue to happen. And so we need to go back and have a longer period of time, pre-pandemic, pre-2008. We need to draw trend lines and look at reversions and things like that. Third, we need to use systemization to maintain discipline, okay? Now back to sort of these mental models and problems that humans have as investors. We make horrible investors as humans because we're emotional. If we want to get the emotions out, we want to be able to maintain discipline, all right? Now, if you want to see what data I'm looking at, well, I showed you some of it. Like I said, I have about 30 charts that I think really frames up exactly where we're at. But most importantly, these 30 charts tell me where I think things will be in 2024. They also show me what are the 3 main assets that I want to be buying. And I'm going to break all this down in a live presentation with you, all for free. There's a link down below if you want to come join this. I'm going to run through all these charts. I'm going to show you the data, the receipts. I'm going to show you what assets I'm buying, and I'm going to answer all your questions live. So if you want to come check it out, there's a link down below. It's all free to do. But the most important thing is that you go and get the actual data, skip the headlines, look past the opinion, get the data, find data that causes you to think on both sides of the argument. And whatever you do, don't make financial decisions with wrong data. They are using it to scare you, to get the clicks, to get the fear porn rage going, but they're also using it to manipulate you so you stay on the sidelines, you stay in cash, and you don't buy up these assets. You don't run for the exits with Bitcoin and gold and real estate and whatever it is. So whatever you do, get the right data. Let me know what you think about this video. A little bit different this time, something something a little bit fresh. Hopefully you enjoyed it. Leave me a comment, let me know. As always, give me a thumbs up if you like the video. If you don't, you can give me a thumbs down, that's okay, but at least tell me why in the comments down below. Subscribe if you're not already subscribed, and that's what I got. To your success. I'm out.